All right, good morning. Call to order the Supplemental Retirement Plan Board meeting for December 2025. Thank you everyone for being here. Let's begin with pledge allegiance and the salute to the North Carolina flag. Pledge allegiance to the flag of the
United States of America, to the republic for which it stands, one nation, under God, indivisible, with liberty and justice
for all.
Salute the flag of North Carolina.
And pledge to the Lord to love and faith.
Thank you, everybody. If anyone wishes to make a public comment, please sign up or email Patty Hall at patty.hall@nctreasurer.com. Please note this meeting is being recorded and will be posted online with the other board materials. We ask that you please mute your phone or computer if not speaking. We'll be taking roll call by name and for all votes, unless there is an objection. A motion and a second will be counted as yes votes. Board members, if you must leave the meeting at any point, please announce your departure. If you return, please announce your return as well. These items must be recorded in the meeting minutes. Likewise, please state your name before speaking. Finally, texts or other recorded communications between board members during the meeting, even on personal phones or public records, to the extent that they concern the meeting. Secretary, please call the roll.
Treasurer Briner.
Here.
Charlie Peruse. Charlie Peruse. Lorraine Johnson. Lorraine Johnson. Lanier McRee.
Present.
James Richardson.
Here.
Bob Shea.
Here.
Raj Singh.
Present.
Steve Bean.
Here.
And Robert Hillman.
Present.
Thank you.
All right, we have a quorum. Okay, all the board members could please take a moment to review the agenda. Does anyone present have an actual potential or the appearance of conflict of interest in any of these matters? Okay, hearing none, let's move on to the consent agenda. Consent agenda consists of the minutes, some plan document amendments, and some policies for participants and employers. The minutes are from the August 21st, 2025 board meeting. Are there any requests from the board to move an item from the consent agenda to the regular discussion items? Okay, hearing none, the consent agenda for the items for the board are adopted as presented. All right, let's move over to administrative matters. I'll turn it over to Jeff Hancock.
Thank you.
Thank you.
So board and partners and staff, we just wanted to take the opportunity to reflect back on the very, very productive year we had for 2025 and share with you some of the notable accomplishments. And again, this was all as is due to your hard work as the board, as our partners, as well as staff. And so sharing these, again, thank you for early in the year granting another fee holiday to our plan participants that creates a savings of about $1.7 million to the plan participants. In the spring, we were awarded a NAGDO award for our 2024 National Retirement Security Month campaign, which yielded great results. We also made several plan enhancements, as you can see here, with a couple of hardship withdrawal type items, and then allowing in-plan Roth conversions for all. So that's really helpful because that kind of opened up that tax strategy to all participants and just not those who are eligible to take a distribution. And then with your help, the board voted to reinvest our fee reserves into our higher yielding investment, which looking over the year has yielded about another $100,000 in annual interest. And then lastly, we had a manager change on the North Carolina Large Cap Core Fund in hopes to enhance the fund's performance. One item I don't have listed here because it's not yet complete, and Jody, keep me honest, but we've been working on a project to move a lot of our employers to a more secure method of submitting their payroll. I think today we've moved north of 500 employers to a more secure method. So that's still ongoing. It's going to wrap up soon, but a lot of efforts around that. And so again, thank you all, board, for all your efforts this year, partners, and as well as staff for all their hard work. That's all though I had to share, unless there's any comments or questions.
Thank you. Your leadership is appreciated. And so a lot of these accomplishments, say thank you. So in addition to the team, we really appreciate all the efforts. Let's move on to our strategic communications plan.
Yeah. Thank you so much. This is Christy. So as Jeff mentioned, actually, this year we won National Retirement Security Month Award for last year. And I wanted to touch on what we did for this year because we blew it out of the ballpark. We did a campaign based on the Retirement Express. We actually went to the North Carolina Transportation Museum and did some filming with the treasurer and Sam. And we had a wonderful series of videos, some of which are kind of a collection was emailed to the board last night. It's also on our board materials, so people can view that. But over the month, people going to the website, going to get enrollment codes, and viewing the steps to enroll was up to 290% over last year, which is pretty extraordinary. Our webinars and individual meetings were up when compared to last year. And most impressively, of course, enrollments increased by 39% and contribution increases increased by 49%. So that's quite extraordinary. And if you want to move through the slides, Patty, we can go ahead and move through a year in review and what we set out to do. Of course, we're always looking to engage, educate, and empower. And that goes for participants, members who are not yet participants, as well as employers. And we did this through webinars, increasing our digital presence and turning things more from PDF kind of things to more searchable things on the websites. So as a participant focus, a couple of slides ahead, we did the Nearing Retirement email campaign, quarterly newsletters, our social media was through the roof. We continue to do webinars, events, and one-on-ones. We had record enrollments this year of 23,000. And the average employee deferral, which I think is so impressive, is over $300. So that's pretty impressive per pay period. We have our Nearing Retirement email. It has just remained steady since it launched. It's something that goes out once people apply for retirement to keep them in the plans. So the delivery rate is good, the unique open rate is good, and the click-through rate remains the same at about 7%. One new thing that we launched in July, over a 3-month period, we started doing an auto email campaign. So this includes registering your account for the first time if you're a new person, increasing those contributions, and designating beneficiaries. From July to September, we sent over 500,000 emails. 34% of those actually logged into their account to take action. And we have some pretty impressive stats. So as we continue this through the next year, I would expect this to grow substantially. So people did take action on designating a beneficiary, which is so important. Putting in their email and registering their account properly, that went up. And again, I just think that this is a really great feature that we haven't used before. It's automated. It doesn't require anything. And it goes out systematically. The employer engagement in the month of October, if you want to move forward a couple of slides, October meetings were up 31%. We had 81 employers adopt or enhance features, which I'm sure Jody will talk about, and 565 employers now offer some sort of contribution. when an employer offers a contribution, their participation rate is 206% higher than those that don't offer that, which is really good. You know, we get a lot of people are taking advantage of that and not leaving something on the table. Our key communications, of course, were through dynamic pages around employer contributions. Again, moving from paper to that digital submission is a big deal. And we offer, I think like once a quarter, we offer Employer Corner, where it focuses in on those things that employers need to focus on to best benefit their employees and participants. We are no longer mailing the signature newsletter. We've taken that 100% digital. There was a lot of money being spent there, and it's much better to be able to spend that in other places where we can really target specific audiences. And again, the web stats are really, really good. I mean, we're up 135%, 105% on the registration page. So this is speaking volumes to what we're all doing collectively in terms of moving the needle. So in 2026, our goals are remain the same each year. We obviously want to increase plan adoptions and employee participation, increase the contributions. We want to make sure people stay in the plans, and we want to just make sure that we're being really effective and efficient with our communications. So we are going to continue this Closing the Gap campaign. We started laying the groundwork for this. We have a lot of people who are 55 and over that are within 10% of being 100% retirement ready. So that's going to be our first campaign. We're going to push hard to get them to 100%. And then we're going to take that down through generational communication. So, you know, in your 40s, you need to be fully funded, swipe right on your retirement, don't ghost your retirement, all that kind of stuff. It's going to be fun. We're going to be targeted, and we're going to really try to move the needle. And I think this is going to be a really good campaign. And the next slide. So, you know, this year, again, we're going to continue to engage, educate, and empower. We're going to enhance our digital content, do those digital targeted campaigns, continuing these automated campaigns, enhance our counselor engagement, really push for those one-on-ones, because those are so meaningful in terms of moving the needle to retirement readiness. Continue to do our webinars with a variety of topics, not just put out the same messaging, but kind of repackaging it for very targeted audiences. And we just want to empower people to make their own choices, enroll, increase, and just stay in the plans through their retirement. And that's all I have.
I do want to commend Christy. I think she was probably a little humble, but this year's campaign, the All Aboard campaign, I hope everyone had a chance to view the video, was really, really fun and engaging. And I think that's what helped drive the fantastic results that we saw. So, you know, fantastic idea. And thank you to the treasurer and
Star of the show.
Sam as well for you making their cameos of interest. The treasurer did waive his NIL fee. We didn't have to dig into the coffers for that, so appreciate
Sure. Imagine how much better would have been if you had a better actor.
But anyway, I think it was just a fabulous campaign, and you know the results. You know, you kind of show that, and so you know, thank you, Christy, for all of that creativity around that.
Jeff Lanier has a question.
Yes, Lenore.
Thank you, Christy. That was really great. And it aligns really well with some efforts OSHR is making. We're working on a campaign to, quote, elevate public service. And I think all the services of the state treasurer's office, including the supplemental retirement, are important to that. And I was wondering if I could connect you with our comms director and let him get some insights from you about this campaign and how we might not only leverage supplemental retirement content, but also learn about what you did and how we might ensure we get such a good ROI as we partake in a sort of statewide campaign about elevating public service to boost not just recruitment, but also retention of state employees, to make sure they know of all the great benefits we offer and why being a state employee is so great.
Yes, that would be great. Thank you.
And a lot of that's the actors that we had.
I'll remember the NIL agreement as we get people on board for this.
It's the roundest of all numbers. All right, moving on, thank you. Moving on to legal matters, we'll talk about the Climax Volunteer Fire Department. Over to you, Reed.
Hey, before I talk about that merger, just a reminder that your annual fiduciary training is coming up, so look for an email from me this month. We have the Climax Volunteer Fire Department, which earlier this year merged with the Pleasant Garden Fire Department. And as with many volunteer fire departments, Climax Volunteer Fire Department was ineligible for Elders or the NC 401k plan. And instead, Climax sponsored a private 401k plan, had its own 401k plan. However, after the merger with Pleasant Garden was the surviving entity. Those legacy Climax Fire Department employees became eligible for Elders and therefore eligible for the 401k, the NC 401k plan, because Pleasant Garden, for legacy, historical, legal reasons, is a member, has been a longtime member of Elders and therefore the 401k. So in working through this with the fire department, they froze contributions to the Climax Volunteer Fire Department plan. And so as of July of this year, those legacy Climax Volunteer Fire Department employees have been eligible to contribute to the NC 401k plan. And after that, we started working on a process to move over the legacy assets. I think there are around 20 participants maybe with legacy Climax Volunteer Fire Department 401k plan assets. So staff's reviewed the plan documents that were in place with that legacy plan, worked with outside counsel, volunteer fire department, and Empower. And kind of the long story short is we don't have any concerns with, from a compliance perspective. We have subject to the board's approval, have a target date of February 2nd to transfer the assets. There'll be a communication to those 20 or so legacy participants. There'll be still working on the blackout period. There will be, we have a final version of a brief merger agreement with them in place that, once again, subject to the board's approval today. As a next step, we'll execute that and communicate with the participants. And so staff recommends the merger. As part of that, there is a brief plan document amendments in your materials. It's consistent with the last three we've had, which go back, I think the last one we had was 2005, 2004, somewhere around there. But it's consistent with those amendments. If there are any questions, glad to answer those.
Anything online? Okay, so we'll need a motion to approve the merger and the plan amendment.
So moved.
Shay, is there a second? Second. Richardson, call the roll.
Treasurer Briner,
Aye.
Charlie Perouse,
Aye.
Lorraine Johnson, Lanier McRee, Lanier, Lanier, are you on mute? You there? Raj Singh,
Aye.
Steve Bean,
Aye.
and Robert Hillman.
Aye.
Carries. Thank you, everybody. Okay, let's move on to the administrative update from our friends at Empower. Thanks for being here as always.
Yeah, morning.
What do you?
All right. We'll try to be pretty succinct today. Christy hit a lot of the good points that, so we don't want to double dip, but we'll start today on Patty, slide 4 of the presentation. Slides 4, 5, and 6 really break down looking back over the last rolling 13 months. So just a few of the observations I'd like to point out to the board today. If you look back over that time period, total plan assets have increased from 17.9 billion to about 19.7 billion as of September. Right on the cusp of another really historic milestone for the 457 and 401k plans. This growth has been really driven by the market increases. We're still in the negative net cash flow territory like we have been for some time with the distribution activity, but really strong increases in the overall total plan participant balances, and then also in the average participant balances as well, where over the last 13 months, the average participant balance has gone from about $56,300 to about $60,845. Goalmaker participation remains strong. The active participation rate remains strong. And then as Christy pointed out, the average monthly deferral amount continues to just trend higher and higher. I was sharing with Christy and Jeff and Sam yesterday that when I first started working on these plans in 2013, the average monthly deferral rate was about $130. And I felt like it took forever to cross the $200 threshold. And we went from about 200 to 300 in maybe 3 years. We crossed that threshold. So just the activity that we continue to see from all the messaging that we do with participants really continues to pay great dividends for the plans. Really briefly on slide 7 of the report, we have all of in the lower part of that slide, the employer activity. As Christy mentioned, the employer contribution activity continues to remain really strong, with about 565 doing some type of an employer contribution or employer match. And this year through September 30th, we've had about 47 employers either add, change, or enhance their employer contributions. Just really continued strong work there as well. We can next go to slide 34, Patty. Slide 34 and 35 break down the net cash flow activity across the plans. And like I mentioned earlier, disbursement activity is outpacing the contribution activity, but with the strong market, the gains have continued to well make up for that, leading to an increase, like I mentioned earlier, of about $1.8 billion. And then on slide 38, we have the rollover out activity. And again, like we have in prior quarters, breaking down where that money is going to, you see where the top activity is in terms of, slide 36, Patty, my apologies. The Edward Jones, Fidelity, and Charles Schwab being the top 3. But still really strong activity in terms of one of the things that we try to track is of all the assets that are eligible to roll out or leave the plan, how are we doing in terms of the assets that are staying in plan? So for the quarter 7/1 through 9/30, just under 95% of all the assets that could have rolled out or taken a distribution are still in the plan. On 37, I want to make sure I hit our call center statistics for the quarter, which really great in terms of the service percentage, with answering 89% within 20 seconds. The average speed to answer was really strong, and then we're continuing to see continued decrease in the abandoned percentage. The one highlight I would say, to kind of piggyback off of what Christy mentioned earlier, the amount of calls that we took in the third quarter were significantly down from the third quarter of 2024, and as you can see, also 22 and 2023. We think that is driven by what we're seeing in terms of the really strong website and app usage. I think that's another huge lift that I've seen in fully getting over to the Empower platform from the Prudential platform. Don't get me wrong, I thought that the Prudential website offered a lot of functionality, but from an app perspective, it was pretty limited. The Empower website and the Empower app, whatever participants choose to use, you can literally do way more transactions than you ever could on the Prudential experience. So I think as participants have gotten used to that, and like Christie's stats prove, we're continuing to see just more and more folks choosing to serve on the website or the app. So I think that could be why you've seen the decrease in the call center stats in terms of the number of participants that have called in. So I'm gonna pause. I'm gonna pause there and see. Is there a
Here's a question.
Okay.
Yeah, I did have a question. And Rob Hillman, are you, in terms of the call center, and the app, are we using sort of chat bots or anything like that, or kind of offloading the calls to the call center, but still representing inquiries from the perspective of the plan participants?
So on the website, there is like an opportunity to ask a question, but it's very limited. Like it's not full AI. Like we're investing in to make that more meaningful for participants. But right now, it's still, I would say, in its infancy of what I think it will be in the next year or two. But it's very easy if a participant is on the website or the app and they need help for them to then quickly call into the call center and get that. Does that help? Is that answering your question, Robert?
Yeah. I mean, partially. Yeah. I guess the question, part of my question was, are people getting the help they need, right? Or like, that's pretty big drop. And are we, notwithstanding the fact that I guess somebody's not calling into the call center, do we still want to track that their questions the questions they're raising, or the information they're seeking through whatever help tools there are, is actually answering their question? I think oftentimes for some of the sites that I use, I'll go on and it'll ask me a question. Hey, did I answer your question? Right. So I've not talked to anybody, but I've certainly gotten some help from their online tools.
Yep.
And I just think, is that information something we want to know? I.e.,
I think the answer to that question is yes. Like we track where participants go on our website or on the app, and the top handful of reasons of why participants visit the app or the website. It's either to check a balance. A lot of the activity on an app is to inquire about distributions, loans. All of that is very self-sufficient and explanatory. So there's always the option participants have where if they have additional questions to go to the call center. So we see some of that activity, but we don't see trends of participants not getting the answers that they need via the website or the app where they're left still wanting more. Does that help with your question?
yes, it does. Thank you.
Yeah, I would also say too that we are continuing to have very strong results. So anytime a participant meets with anyone on Jody's team from our field force, or anytime that a participant calls into our call center, they're given the ability to take a survey after those engagements, and both from the survey results with Jody's team and the survey results with our call center team, those continue to be very strong. Like I think for our call center it's on a 5-point scale. I haven't looked at it in a couple of weeks, but I think that we were at like 4.6 was the average score on a 5-point scale. And then Jody's team, it's on a net promoter score. So anything over 70 is considered world class. And your score was what, 96? 91. 91
with over
right now.
1,000 surveys.
Yeah. So, but we monitor all of that and take all of the feedback that we get very seriously.
Thank you.
Any other questions? All right, Jody, I'm going to pass it over to you.
Okay. Well, hi, good morning. Nice to see everyone. One of the ways we measure our field team is through the lens of participant engagement. And so I'm going to speak starting from page 38 of your board report. Engagement results reflect the number of people that we have met with, either individually or in group settings, and how they interacted with us. And in third quarter, counselors met with over 26,000 employees and participants, which brings us to a total of almost 70,000 engagements year to date. That's about 9% higher than where we were this time last year. And it's the highest year to date engagement total since before the pandemic. So we're really pleased to see the interest and awareness increasing as it's reflected in these numbers. Monthly, the team is averaging over 2,000 group and individual meetings, over 7,500 total engagements, with almost half of those engagements occurring virtually. So we do more on site with our group meetings and more virtually with our individual meetings. So people are really responding to having that virtual opportunity available to them. About 70% of our individual meetings are done virtually. So certainly something, one of the blessings that came out of the pandemic was the ability and the comfort level for folks to develop in that realm. One of the initiatives that helped boost these figures was a special focus over the summer on K-12, our K-12 environment, school systems with overall lower participation rates. So we targeted 14 school systems across the state that had lower participation rates, and we had a very purposeful and intentional campaign with them to first of all meet with their primary contacts, our centers of influence, to engage them. We conducted an employer wellness review with each of these school systems. This was where our counselor team went in and showed them trends with these plans that were relative to their data, that subplan's data, and compared it statewide to what school systems were doing more broadly. And oftentimes peer pressure can help motivate some engagement there. They realize that they're maybe not keeping pace with some of the school systems that they tend to measure themselves by. So that was very effective. And then after that, our counselor team offered individual consultations to principals and department heads in order to engage that audience, because they are the gatekeepers to the employees. And so we leveraged those meetings to access the employees and get to meet with almost 2,500 employees across those systems in 356 group and individual meetings. That led to 570 enrollments and rate increases during this very defined period. Additionally, as kind of we were very happy to see this. Not only did it open some of those doors, but it opened some other doors we hadn't quite anticipated either, like being included in new employee orientation meetings year round, not just the back to school new teacher orientation day or what have you that every school system hosts. We're very active in those annual events, but this opened the door to actually be a part of new employee orientations on a monthly basis in at least one large school system. And it also brought in a plan enhancement from another very large school system. Now, the plan enhancement was the addition of percentage-based contributions for this school system, which doesn't seem like a big deal, but it actually impacts, retirement readiness, retirement preparedness for decades to come, when somebody can express their contribution as a percentage of pay instead of a dollar amount. When these plans were first introduced many years ago, back in the 80s, the only option was a dollar-based contribution rate. So We'd enroll somebody and they'd put $25 a month in, and 10 years later, guess what they're still doing? $25 a month. So if we can shift that just a little bit and get them to do 1% or 2% or what have you of their paycheck, then at least their contributions are remaining proportionate to their salary growth over the years. So leads to better retirement outcomes. And that was an initiative that drove a lot of the activity that we saw in third quarter. We also have, of course, over 1,000 governmental employers that are part of these plans. And so the counselor team is tasked with building relationships with all of those employers. And they logged over 1,100 meetings with their COIs in third quarter. These are HR directors, finance officers, the senior leadership, executive leadership at various organizations. And so we're averaging about 345 meetings monthly there. Another lens that we measure our progress by is on page 39. That's plan enrollments. We've touched on that here. We're doing great with enrollments. Third quarter produced over 7,500 enrollments, bringing the year-to-date total to over 20,500, which is our best year-to-date figure in plan history. So we're super proud of that. And then the average contribution rate at $308.31 is up over 4% from 2024. And the number of rate increases grew about 5% year over year. Moving on to pages 40 through 44, you'll find that one of the reasons for the robust activity is that counselors have worked with these employer contacts in many cases, over many years to implement plan design enhancements. And on these pages in your report, you'll see the different types of plan enhancements that employers have elected for 2025. Over 50 employers are represented here, but I think the important thing is that these changes impact over 40,000 employees, over 40,000 participants in the plans. In case you're wondering what an enhancement is, an enhancement is a new plan adoption. So somebody adding the 457 or adopting the 401k, it's a new or increased employer contribution program, the enablement of that percentage-based contribution feature, or the election of auto escalation. So we've got all of those listed for you on the pages that I referenced there. And what I will tell you, the ones that I'm most excited about, I'm a statistics person. I like the numbers side of things. And I am super happy to say that we got 2 new counties to add to our employer contribution list. Okay, Transylvania and Rockingham counties both initiated employer contribution programs for their employees at some point during this year. And that brings our total to 70 counties out of the 100 in North Carolina. So 70% of our counties are now making employer contributions available to their employees. So fourth quarter is shaping up to be a great quarter as well, because we got kicked off with a great NRSM campaign. And I look forward to bringing you those results at our next board meeting. But are there any questions for me about what the field team is up to or any of the information I've shared?
Thank you.
All right, sure. Mike, anything else?
We appreciate the partnership. Thank you all.
Thank you so much.
We'll now move on to the investment update with first Kellen.
Thank you for being here.
Thank you for having us. And for those on the phone, this is Elizabeth Hood speaking. But thank you all. It's great to see you this morning. As we walk through the investment updates, we'll go ahead and start with capital market performance, just to set the stage for the environment that your managers have been in, what's been impacting performance of investments of participant capital. We'll talk a little bit about the participant level options and then what's driving that underneath each of those participant options. We're then going to give you an update on the project that we're working on for the glide path within Goalmaker, and then we'll wrap up with a deep dive on stable value. Sound like a plan? Okay. right, we'll go ahead and jump in. Yes, thank you. Here on page 1, U.S. equity performance. So again, there's a few things to cover in the capital markets that Weston's going to talk more about with managers. So we're going to start with U.S. equity. So for the quarter, the broad market was up 8.2%. Year to date, up double that, 17.4%. So if you think about long-term averages, looking 25, 30 years, generally speaking, equities are up 8 to 8.5%. So we basically got the long-term average in one quarter. So that's a pretty healthy return there. And again, year to date, up over 17%. In terms of what's driving that from a style perspective, we're seeing generally growth is continuing to outperform value for the most part. And then from a capitalization perspective, we did see small cap outperform large cap this quarter, which is a little bit of a reversal from what we've been seeing. We've been talking in large cap for a long time, kind of since post-pandemic, about the concentration within the large cap index. So the theme there has really been a small number of companies. It's been 7 for the last few years. We call it the Magnificent 7, have become a really big percentage of the Russell 1000, of the S&P, and an even more concentrated position within the large cap growth space, the Russell 1000 growth. And we've talked a lot about that really driving performance. The theme that we've been seeing since April 8th, so a little bit after Liberation Day this year, is more factor related. So within large cap, still have that concentration in the 7. We've seen that broaden out a little bit. So we're seeing a little bit more opportunity beyond those 7 names, which creates some opportunity for your active managers. More recently, though, with this factor exposure, that's especially hitting within small and mid cap. So more specifically, the quality factor has not been working. So we've seen a big rally from lower quality names that don't have earnings or even have negative earnings are outperforming. So from April 8th to September 30, non-earners were up 70%. Compare that to 35% for companies that had any sort of earnings at all. Within the last quarter, that was 25% versus 8%. So companies that didn't have earnings were about 3 times higher in return. And that's going to impact your active managers a bit too. The other factor that's been really driving is momentum. So that tends to include within the healthcare space, biopharma. So think about riskier, earlier stage pharma companies where maybe there's a drug potentially coming to market. It either does well in the test or it doesn't do well in the test. It's a really binary outcome. So those tend to be higher risk. We're also seeing a lot of momentum from cryptocurrency and quantum computing, which is basically AI. So those have really been the drivers. As you think about institutional asset managers, they tend to favor higher quality companies, and especially those that we look at when we're thinking about participant capital for the supplemental plans. We tend to think longer term. We then tend to think higher quality as opposed to some of the higher risk short-term opportunities. So all that to say, the result here is within the active management space, less than 25% of active managers have outperformed the index year to date. Again, all this teeing up performance. So this has definitely had an impact on the active managers within the plan. So that's a pretty broad theme that we've been seeing, is that low quality rally has really been impacting. We do continue to take that long-term view. So your managers are not ignoring these areas of the market. They're being a little bit more strategic and long-term focused. So you do have exposure to healthcare, but maybe a broader area. So maybe more diversified companies that are less dependent on, for example, one drug trial. Within technology, you do have exposure to AI, but maybe a little bit of the less speculative, again, taking a more diversified approach. So it's not that you don't have exposure, it's just that it's a little bit more quality focused and a little bit more of a long-term view. So we'll see that when we get to individual manager performance, but just wanted to share a few of those comments on what's driving the US markets. On the next page, page 2, we'll look at international equity. So here, good solid returns, a little bit behind US equities, but still very positive. So the broader market, so the MSCI ACWI ex-US, that's a blend of developed and emerging markets, was up 6.9% for the quarter. and up 16.4% for the year. So again, very healthy returns. Small cap has been participating well in addition to larger cap, and we've seen strong returns from emerging markets, both for the quarter and year to date. A lot of that led by China. So easing trade tensions and better performance there has really given a little bit of a boost to emerging markets. And then wrapping up with fixed income on page 3. Within the bond market, we saw the Fed cut rates 25 basis points, or 0.25% in September. This was the first cut in 9 months. So taking the new target range down to 4 to, I think Fed's targeting 4 to 4.25. So the lowest we've seen in the last roughly 3 years. So we've seen continued outperformance in credit and securitized. So kind of anything with a spread over treasuries has done well, and we continue to see spreads tighten there. So that creates opportunity for active managers within the fixed income space. Okay, any questions on the broad market environment? If not, we'll move forward to see how this is impacting participants directly. So on page 4, this gives us a snapshot of the underlying allocations, focusing on the participant level. So these are the options that participants see when they log in. So you'll notice first and foremost at the bottom of the page, we saw an increase. So that positive market environment led to an increase from investment returns of about $900 million, which more than offset the $72 million in outflows. So we saw good growth in the plans, ending the quarter rather, just below $19.7 billion. So we're getting really close to that $20 billion mark for total plan assets. So seeing good positive growth there. Also led contributions there to the momentum from the communication campaign, increased enrollment. We would expect that this will continue. And then on page 5, we'll look at the performance. So what's driving returns. And here again, we're starting at the participant level of what they see, what options are available to participants for investment. The top half of the page are the passive options. So participants can invest passively in all of the major asset classes and also tips. What we look for here is tight tracking relative to the index and low fees. All of the options are delivering there. And then within the active space, we spent a little bit more time, a few more drivers to look at there. Stable value continues to perform well on an absolute basis, a little lower than money market during short periods of time where we see higher rates, but overall good, steady, consistent compounding of returns, which is what we expect. And in the top decile over all time periods. And Weston's going to go through, we have our annual stable value deep dive at this meeting, so I won't spend too much time there. Fixed income also outperforming over all time periods. Large cap has started to come back, a little bit of a rough quarter. So all of the equity space, again, we just talked a little bit about that third quarter environment year to date, but especially third quarter. So all 3 of the equity options have underperformed in the third quarter. But large cap has outperformed over the last year, over the last 3 years. So we've seen good recovery there on a relative basis. And again, we're talking about relative. We say outperform, underperform. The absolute performance is still quite strong. So we're talking about over 3 years, 25% for large cap. So really, really healthy absolute returns too. International outperforming over that 3-year period, 21.8, a little bit behind benchmark quarter and last year. But again, on an absolute basis, the last year up 14.7%. So still very healthy on an absolute basis. And then small cap is where we're going to spend a little bit more time. You probably picked up on that in the earlier comments, but that's where we've really seen the biggest challenge for active management. So positive returns up 15 for the quarter, up 2% for the year, but pretty far behind the benchmark. And so we'll talk a little bit about what's driving that more specifically for the underlying managers within the funds. Okay. Want to take us through some of the.
Sure. I'll take you to page 9, and we'll maybe just jump straight into small cap there on the bottom of the page. And you'll note that all the managers really struggled for the quarter. And if we were to rewind to last quarter, we'd see a very similar theme. A lot of that due to effectively doing what you all hired them to do, which is buy higher quality stocks with good return on invested capital, lower valuations, whatever kind of the thesis is, that thesis has not been working since that April 8th timeframe. And, some might say, well, it's post-Liberation Day, a lot of the tariffs. I think a lot of it might have to do more with, the kind of the whispers around what's going to change within the Fed. And will the Fed remain independent? Will the Fed continue to lower rates? So you had really kind of this behavior that we typically see when, the expectation is going to be much easier monetary policy going forward. So, I don't think there's really too much to go into here. I would say Brown Advisory is the one that we're paying, maybe a little bit more closer attention to. They had some softer performance prior to that April 8th timeframe, and really kind of that, we don't want to see them dig a hole too big that they can't get out of it. But that is one, again, as you look at the portfolio companies, you look at the operating results of some of those portfolio companies, they've been in line with expectations for Brown. It's not that they've made a lot of mistakes. It's more of, they just do not own a lot of these non-earners, a lot of the quantum computing, a lot of the cryptocurrency, what they call now, there's a new company type called a DATCO, which effectively is a digital asset treasury company. And they issue more stock and buy more cryptocurrency. And that's the business model, which works when cryptocurrency is going up pretty wildly. But when, cryptocurrency starts, retreating, it's a challenge. So, I think the poster child of this is MicroStrategies, now relabeled Strategy. It's actually down, was up pretty dramatically kind of when Bitcoin was hovering around 120,000. But now is down 40% year to date. So you have seen some retreat from some of this. And so Brown, given what happened in second quarter, third quarter, and then really into October, that dynamic began to break up a little bit more. November, they're beginning to outperform their index, outpacing their peers a little bit more, just given that quality emphasis. So maybe with that, this is, performance. There's not too much to read into the numbers. In the theme that we're seeing across all managers is the higher quality portfolio you had, the more you underperformed. What I think is possibly more important is on page 13, really 12 and 13. And what this is as we think of a watch list, this comes from our manager research group. And every quarter we are effectively re-rating the managers and re-rating the results, and not just looking at performance, but also looking at some of the other soft factors. So the people, the process, philosophy, the product dynamics, things like that. And just focusing on what's changed. And I'll start with Sands, and this is jumping up to large cap. But Sands continues to be a manager that we're reevaluating. The good news for Sands is their performance has picked up over the last year, and they are a key driver of the 3-year return for large cap being ahead, as Sands has rebounded pretty dramatically here over the near term. Yes.
You have a question.
Oh, yeah, sure.
Taj?
I'll pause
Yeah.
for
Yeah, thanks for taking my question. I'd send it as an email as well. But I'm looking at the prior page in terms of the management fee for these fund managers. The international equity, Acadian, WCM, they are the highest, but I look at the performance also is pretty strong. But the mid cap, which is Ernest and Alliance Bernstein, they are like 1.5x the others. What's your view on their performance relative to the kind of fee that we are paying them?
Yeah, I think all of them would agree that over the near term, they're not really justifying the fee. I would say on relative, and what we do here on this sheet is just to make everybody clear that gray line shows effectively if one of your employers went out on their own and said we want to start our own 457, and they would pay effectively mutual fund rates. So that North Carolina SMID Cap Core, that overall weighted fee of 35 basis points compares very favorably to what
that Callan median expense of about 81 basis points. So institutional mutual funds generally charge about 81 basis points. Then for the actual managers, these are separate accounts. So what we're trying to do is gauge how competitive is AB or Earnest relative to other institutional separate accounts that size. So even relative to other institutional separate accounts, they're about 20 basis points lower than what their comparative peers are. So I would say that is competitive. Now, are they, adding value over and above what that, the market index is right now? No. And, that I think effectively they're going to have to all improve, and we're just going to have to see a market cycle, for that to happen. But, here over the last, especially 6 months, the frustrating thing is going into or coming out of first quarter, most of these managers were outperforming. And then beginning second quarter and third quarter, it just active performance dropped off a cliff. And honestly, in my 20 plus years of doing this, this is the strangest 2 quarters that I've seen for active small cap managers. We would expect this from large cap growth in particular, where just a few stocks are dominating the market. And small cap, it's not a concentration problem. It's just that a lot of junk took off. And so, I think the long-winded answer to your question is note that, I think relative to peers, fees are competitive, but, are they adding value over and above their fee? No, not at this juncture.
And I'll just add one thing. It does, I think, speak to the benefit of the structure that you all have adopted of having the active passive mirror. So for participants who feel like, hey, I'm not getting the bang for the buck out of active management, they have the option to transition into passive. So there is a lower cost option for those that maybe are concerned about that.
At a minimum, I think, given the BlackRock performance versus the other three, something worth at least the allocation, the 30-30-10 versus something else looking to the future, just for your consideration.
That's a structure that we've looked at, and we'll continue to look at it periodically. Instead, you have a passive option that you offer to participants. So this is meant to be an active option. And so really that 10% is meant to be more of a liquidity sleeve than it is to be, a passive stuffed within an active option. We want to keep the active option truly active. And it ultimately in time, we do believe that this will add value over and above its index, but that this near term has been difficult.
Okay, thanks.
Certainly. All right, going back to page 12 and just mentioning SANS, and again, I think that the two key watch areas here are mainly on short-term and long-term performance. There has been some personnel turnover that, again, is maybe a little bit more notable than it is cautionary, but they remain a manager on your watch list. There's really no change in the sentiment from Callan's perspective, but continue to see them moving in the right direction this quarter notwithstanding, but we do continue to have conviction in SANS and their process and their philosophy. And then really the bigger change is, or the one change here is on page 13 with Brown. And our overall, consensus, thought on Brown is that we remain cautionary on the product overall. What changed is that short-term performance we highlighted as cautionary last quarter. That was a change, and then change here for cautionary for the long-term performance. And a lot of that shorter-term performance is beginning to run into the longer-term performance. As you look at Brown's consistency, their performance consistency pattern over the last, not just the last 3 years, but how many rolling 3-year periods do they outperform the index? It is off the charts good. That said, if you look back, this has been the worst 3-year performance period in their history, that you all have had them. And, that highlights why, we've kind of made that change to cautionary on some of the longer term performance. But again, should some of those profitability factors ultimately pay off like it has through history, Brown should perform well here going forward. And those are really that is the one key change, and then our manager research, call it watch list, if you will. But happy to take any questions before we transition to the next topic. Perfect.
Okay. All right, well, we might shift gears a little bit, and we have a one-page summary. So what we're going to cover now is.
I do have a brief question or a quick question. Yeah, Rob Hillman. Going back, you mentioned, you want to offer this option as an active option. I guess what guidance do we give the participants about considering active options? Like, because they're not necessarily going to be bouncing back and forth between the options, are they, or do they? I don't know.
They do have that ability to go back and forth between active and passive. I'm not sure of the guidance offered. I would say there is some very subtle guidance offered in that, should a participant choose Goalmaker, they go fully passive in large cap and then fully active in small and mid cap. So that, while it's not necessarily guidance, that is, call it this board's best thinking as it relates to building that target date, effectively option.
Okay, thanks.
Okay, well, we'll take a little look at Goalmaker. So here, thinking about, again, with the campaigns, bringing more and more participants into the plans, increasing contributions, we want to make sure that they're having a good experience within the investment side of the lineup. So the board approved last quarter reconsidering the construction within Goalmaker. And so historically, the 3 glide path structure has served participants very well. What we want to do now is take a look at the information that we have available, look forward and say, what's going to be in the best interest of participants going forward in this different market environment. And so the board approved consolidating from 3 options down to 1. So simplifying the opportunity for participants making their decision-making process a little bit easier, a little bit more streamlined. So you all approved that. You also approved, rather than just adopting the moderate glide path, which was the middle of those 3, to take a fresh look and to go back and say, okay, let's look at participant demographics. Let's look at benefits holistically. So specifically considering the defined benefit pension benefit that most participants are also accessing. Revisiting current capital market assumptions, looking forward over 10 years, where are we in the market, and reconstructing into a single glide path. So that process is well underway. We've kind of mapped out the steps and where we are, but I'll just give you a high-level overview. We've had our initial kickoff meeting to talk about those different factors, to revisit objectives, priorities, focus areas. Is anything on the table, off the table? Callan then went back to the drawing board and reconstructed the glide paths based on those broad objectives. We've shared our initial, so we came back with 3 different alternatives. So we've got the current and then 3 others to consider. The big themes there are kind of twofold. Real assets, so taking a look at the current composition of the real assets portfolio, thinking about inflation hedging. Is this the right mix? Is there a better way to approach it? What kind of exposure do we need? And we've also been taking a look at fixed income. Are there further diversifiers, different types of credit that we could explore that might further enhance the total return of the fixed income portfolio? So those are 2 themes that we're exploring. Within the 3 new paths that we've developed, we've looked at addressing the small cap bias. So there's been a bit of an overweight to small and mid cap within the current glide paths, looking at the composition from region, so US versus non-US, and moving that back a bit. Looking at equity exposure, especially in the 60 to 70-year-old range, making sure that we have enough but not too much growth opportunity there. We're looking at stable value. Should we maybe curtail some of that exposure a bit? Again, thinking in that total return context. and then looking at the TIPS exposure. So it's currently 1 to 10 years. Would we potentially benefit from having broader TIPS exposure? So those, we've again presented those. Staff has been reviewing the initial findings. It's a pretty iterative process, so we expect a lot of back and forth of, maybe taking one of those themes, digging in deeper here, taking another one, digging in deeper there. But we're very much on track to come back to you all in February with a summary of what we have found and some of the key decision points that the board will be faced with in terms of the overall allocations and some of the underlying structures there. And it's come up today, active versus passive is also something that we're considering in every different asset class as we go through the glide path of what's in the best interest long-term looking forward. So we'll be bringing all of this back to you all in February. So be excited. And there's going to be a lot of really interesting, well, we think it's interesting and exciting. Hopefully you do too. But we'll have a lot of good discussions, I think, in the February meeting as it relates to the new glide path. So everything's on track. Any questions on where we are, where we're headed?
All right, so
Stable value.
last up, stable value review. And this is an annual project that Callan takes on just to reevaluate your current stable value provider. This, it's a large allocation within Goalmaker as well as what participants actively select on their own. And so we want to take into account the importance of it as well as what might have changed. And so really for the last year, from a people, process, philosophy standpoint, Galliard remains a key provider here for stable value solutions. Callan has a favorable opinion of their stable value approach, of the underlying fixed income strategies that they use. As you think about the role of stable value within a 401k plan or a defined contribution plan, you're meant to offer diversification. And what does that mean? Well, you have growth assets being equity, you have income assets being fixed income, and then you have a capital preservation option. This is meant to be the capital preservation option. So I think a lot of people, get hem and haw a little bit about, well, is this getting the nth degree of income? That's not really its role. Its role is meant to offer capital preservation. So, from that standpoint, we believe Galliard hits on, that objective and what they are going for. I would say one of the key things, just offering some institutional memory, that as we looked at them, if we were to look at this 4 or 5 years ago, there was a little bit more concern about Galliard, an ownership transition that occurred. Effectively, Allspring spun out of Wells Fargo Asset Management. They were bought by 2 private equity firms, GTCR and Reverence Capital. From what we see is that the 2 private equity firms continue to leave Allspring and really Galliard. I would say Galliard remains fairly independent of Allspring. So they continue to leave them alone, allow them to operate and do what they do best, which is manage stable value and call it fixed income portfolios. So we would say we're fine with kind of the ownership changes that took place back in 2021.
What are the strategies of the 2 private equity firms that acquired them?
So GTCR is known for buying asset managers. So and I think more traditional buyout strategies. So these are meant to. They will very likely, set the next 3 to 4 years, likely be changing some sort of ownership transition or transitioning to the next owner, be it a strategic buyer or another financial buyer. But that would be the expectation. We don't think that puts, sheds an unfavorable light on Galliard. But so long as I would say for GTCR, from our perspective, they've transitioned many managers like this with that, pretty seamless.
Thanks.
All right, and so the other thing that you would observe if you looked at this 4 or 5 years ago was that there was also a transition of leadership that occurred back in 2019. Some of the key founding partners got to that retirement age and decided to take retirement. And so we watched that. Since that time, the personnel has been fairly stable at Gaillard. No concerning trends among people employed there or key people leaving the team. Continues to be run by very credible institutional quality stable value managers. And then I would say that the other key things here to point out have less to do with Gaillard, more to do with the stable value environment. As we're going around talking to clients, one of the things that we've heard over the last 2, if not 3 years, is why do we have stable value? Why don't we just offer money market? And so we continue to see some positive trends pointing back to stable value as being a slightly superior offering for capital preservation. These last 3 years, and with the steep interest rate increases in 2022, money market funds shot up, offered a much better yield than the crediting rate for stable value. That dynamic is slowly evaporating to where, Elizabeth mentioned as of quarter end, Fed funds rates was 4.0 to 4.25. Post that time, the Fed has decreased interest rates by a quarter point. And then the expectation for next week's meeting is that they'll decrease again. So 3.5% to 3.75 would be the expected, call it yield for the Fed funds rate. Money market funds tend to trail that a little bit, but can stay fairly close to that. I think the key point here for stable value funds relative to money market is will that, call it 2-year maturity, be above where the Fed funds rate is. And over most periods in time, that has held true. There's been a bit of a term premium. So as you go out in duration, you're paid a little bit more in income. These last 3+ years have been a different animal in terms of the yield curve being inverted as much as it has. So we do continue to see some improvement in what stable value can offer relative to money market funds, and that crediting rate being below where money market yields are, that we would expect that dynamic to change over the next year to year and a half. All right, so I'll go quickly through this and just point out a couple of pages. We'll jump to page 10 and just talk a little bit about performance. On the pages that Elizabeth showed, we show those net of fees, and we have to show those versus a different peer group. We show it versus the commingled peer group for stable value. This is looking at a true separate account peer group, which is a more apples to apples comparison, but it's also shown gross of those investment manager fees. It's a tougher peer group to rank high in because stable value separate accounts tend to be more competitive as it relates to returns. So rather than being in the top decile of returns here for relative to other stable value commingled funds versus other separate accounts, Gaillard still ranks around the top third over the 3, 5, 7-year time frames. And then on the next page, we show the 2 key metrics. So that's backward looking, going to a little bit more, what's happening now and what's likely to happen in the future. The crediting rate is what is being returned to participants now in the form of income, and we want to see this above median. And so across most all timeframes, that blue line is where Gaillard's crediting rate is, and the white line in the shaded gray area is where the median of the peer group is. So again, more difficult peer group to beat, but Gaillard does remain above average on those on the crediting rate. And then for the market to book, which gets amortized into the crediting rate over time, you want to see this market to book be closer to 100 there. But all stable value funds with those interest rate increases took a hit on the market to book. That market to book continues to improve, but Gaillard does remain close to the you call it the top decile here for market to book relative to peers. And that has a lot to do with their more conservative positioning.
Weston, could I ask you to define wrap provider? I'm not familiar with that term.
Okay, so effectively a wrap provider is an insurance company that there's a fixed income portfolio underneath the hood for stable value. And then an insurance company comes in and says, you know what, we're going to guarantee that we'll pay out participants at book value, right? And so it's effectively an accounting gimmick to allow for that stable $1 NAV anytime for participants. So the insurance company wraps that fixed income portfolio, and they're effectively the wrap provider, and it allows you to transact at book value.
Okay, thanks.
And how many times historically have the insurance companies paid that?
Certainly in 2008, there were some issues. Yeah,
I don't think anybody did in 22.
Yeah, I don't. Yeah, 22, and
I don't think so.
I know Galyard listens into these, so it would be better in a better position to answer that question. But it's fairly rare, and so that's why kind of that rate to wrap this portfolio is 17 basis points. It's not terribly significant relative to other insurance offerings. That's true. All right, and so page 12, again, I mentioned the more conservative positioning. Galyard does tend to be, has been a little bit higher in duration relative to their peers, but certainly within that acceptable range. I think the more important metric here is on the right with that credit quality exposure, high quality portfolio. If you were to compare some of the peers that have performed a little bit better than Galyard over time, they tend to utilize more non-agency mortgage-backed securities, lower quality commercial mortgage-backed securities, and wrap that in there. And some wrap providers will allow that. Galyard has remained conservative and continues to manage a high-quality portfolio. On page 13, we show all the managers, and I would just caption that with saying all managers over that 3 and 5 year time frame are in line with their performance expectations and outperforming their respective benchmarks. The key change here is you see IR&M. IR&M replaced Jennison a few years ago. It's as one of the key or one of the fixed income underlying managers, and so or not a few years ago, within the last year. So that has been one of the key changes here for the managers of stable value. With that, I'm happy to answer any questions on Galyard or the broader stable value environment. Thank you.
Thank you. Appreciate it. Okay, let's move on to policy statement discussion. Chris.
Thank you. Good morning, everyone. This is Chris Morris. So I will be talking to you about the review of the Supplemental Retirement Plans Investment Policy Statement. So this is a review we do annually. Staff and Callan helps us out as well. We take a look and propose any changes to improve the IPS. So the red line version is in your materials, and I will review the proposed changes. And of course, if anybody wants to go into any other item around the IPS, happy to answer any questions on that or discuss anything further there. So for this year, the main substantive change is the replacement of the investment management division with the North Carolina Investment Authority, along with additional language around compliance with the new general statute 147-69.4A, which allows the supplemental board to request investment services from the NCIA. So our intent is to continue the responsibilities that the investment division handles within the NCIA, essentially holding things status quo from that perspective. So we will use the approval of this IPS as the request required by statute to provide these services. So the next steps would be to present a resolution at the next NCIA board meeting in December to consent these services. This was previewed with the NCIA board at the November meeting, and we don't anticipate any complications with that resolution. So you'll see throughout the document the change from Investment Management Division, or IMD, to North Carolina Investment Authority, or NCIA, throughout the document. And you can see the new compliance language is on the last page, on page 37. So is there any questions on that? That's the biggest change and the most substantial change to the IPS. So I want to ensure that there's no questions on the transition over to the NCIA and the statutory requirement for the board to essentially request the services from NCIA. Questions? Okay, good. So if there's no questions on that, I'll highlight a couple of the other less substantive changes that we made to the document. So as Jeff pointed out, and we discussed at the last board meeting, we replaced Macquarie with Boston Partners in the large cap core fund that was approved at the August board meeting, and the transition occurred in September. Transition went smooth as planned, and Boston Partners took over officially, I guess, right at the beginning of October. So we made that change in the document under Appendix A and Appendix B, where we recognize the underlying managers for those white label funds. The other change that was made was there was the addition of global listed infrastructure asset class within the investment objective sections for the inflation responsive fund. So these are on page 12 and page 15 if you want to look. This was done as a response to BlackRock, who run the BlackRock Strategic Completion Fund, which is the manager within the inflation responsive fund. They added a global listed or publicly listed infrastructure mandate within that fund. So they have a small allocation now. I think they initially targeted 14%, in addition to the other three components, which was essentially REITs, commodities, and TIPS. This was done to try to increase the inflation sensitivity of that portfolio, as well as hopefully increase the return potential of that. So that change was made earlier this year, I think right at the beginning of Q4, and we added it to the IPS. And then the only other change that was really made was we added some introductory paragraphs to improve the readability in certain sections, specifically the oversight and governance section, as well as the portfolio design and implementation function. So you can see that in the red line version there. That was, again, just done merely to improve the readability of the document as a whole. Again, that was the main changes. That was the main thing I wanted to point out to the board, and certainly happy to answer any questions or go into any other part of the document if folks want to dig into any of it.
No questions. I'll ask you offline. I have a couple, but I don't want to.
Okay, sure.
Anything online about the IPS? Okay, let's move over to the compliance summary.
We do need the board to approve the IPS.
Okay. So I need a motion to approve the amended IPS.
So moved.
Second, Steve.
All right, we'll take that. Thanks.
Who was the motion?
Robert Ullman.
Okay, Robert. So we'll call the roll, please.
Treasurer Briner?
Aye.
Charlie Peruse? Charlie Peruse?
Aye.
Lorraine Johnson? Lorraine Johnson? Lanier McRee?
Aye.
James Richardson?
Aye.
Bob Shea?
Aye.
And Raj Singh.
Aye.
Thank you. Let's move on to the compliance summary report. Chris.
Yes, thank you. Good morning, everyone. Similar to the last report, I'm going to just go over the investment policies, executive order, and investment guidelines summary to check if there have been any changes. Starting with the investment policies, there were no prohibited holdings held in the supplemental retirement plans group trusts during the quarter. I'm going to executive order.
Can I just add one thing? Sorry, Chris.
Yes.
I just wanted to, for the divestment policies, we are going through our annual process to update the lists and provide that by statute to our all of our external investment managers. So that's in process, and we typically send those out by year end. So just wanted to point that out as well.
Thank you. Moving to executive order. So BNY continued daily compliance, testing for prohibited holdings identified as communist Chinese military industrial companies, abbreviated CCMCs, related to the Presidential Executive Order 14032. No SRP investment managers were invested in CCMCs during the quarter. And lastly, investment guidelines. The supplemental retirement plans staff continues to monitor investment manager guidelines daily, and there were no material issues during the quarter.
Any questions, for Chris? Thank you.
There's no public comments.
All right, so public comment section with no public comments. We'll consider that closed. We have time reserved for any board member comments. Any thoughts or anything from the other board members? Okay, hearing none. We are down to a motion to adjourn. Thank you, everybody, for your time. I will look for a motion to adjourn.
So moved.
Shay, second. Rich. We'll do a roll call vote. Why not?
Treasurer Briner.
Aye.
Charlie Peruse.
Aye.
Lanier McRee.
Aye.
Raj Singh.
Aye.
Steve Bean.
Aye.
And Robert Hillman.
Aye.
Perfect. Thank you, everybody. Happy holidays. Appreciate your time and your efforts today. And we will see you in the new year.
Thank you. Happy holidays.
Is that a new record for